Welcome to the Real Estate Agent Market Update and Mindset Podcast. I'm your host, Angie Gerber, and every Monday you will get a snapshot of what you need to know about the real estate market in real time. And Thursday's episode will focus on your mindset and leveling up in your real estate business because let's face it, business problems are solvable. It's all the other personal crap that we drag into our businesses that keep us stuck. So let's get to it. All right. Welcome, Nikki. Thank you so much for joining us at our meeting. I know we have a lot we want to cover today. So we'll let you begin. I know we wanted to do a little bit more on the student loans, on interest rate update.
Okay.
And update on the HOAs and insurance.
Yeah, we know that one too.
That's a hot topic as well. Yes, absolutely. So let's start out with interest rates because that's always the fun one to get out of the way first and foremost. So about a week and a half ago, we were on a really good track, seeing interest rates down in the lower sixes. I was locking people in at 6.375, 6.5. Everyone was happy. Japan announced that they have a negative GDP this past week. What that means is that the amount of income that they're bringing into the country is less than by a huge amount that people are spending in the actual country on their product. So when that creates a negative GDP, that actually hurts the international bonds, international situation from a stock and bond market, which in turn hurts the 10-year treasury, which in turn increases mortgage interest rates. So when they went negative on their GDP, it created a huge issue in the mortgage interest rate because of the trickle-down effect. And we saw rates go up to 6.875, 7.25. I even saw some as high as 7.5 in a couple of the days. Settled back down afterwards. Now we are still in that 6.875 range, so higher than what we were a week and a half ago. The big thing right now is that the Fed is refusing to drop their interest rate. The reason that they're doing that is because they feel like inflation is not going to drop in the next month, next quarter. The reason that they feel that way is because they haven't seen the effects of all the tariffs, and they're basically scared to see what's going to happen from a tariff situation. They feel like, even though they feel like the number of new jobs added in is going to be less than expected and unemployment is going to rise, which is also a factor as to why they would drop their interest rate, they feel like the inflation piece is more important than the unemployment piece. If we have higher unemployment, we have less jobs out there. Normally, the Fed will make an adjustment on their interest rate to help stimulate other parts of the economy. If we have lower inflation, the Fed will then also drop their interest rate in order to meet that lower inflation mark. But since they feel like the inflation number is actually going to go back up, they are saying we're not going to lower our interest rate. As a reminder, the Fed interest rate is not the mortgage interest rate. However, it does influence the 10-year treasury bond, which is what the mortgage interest rate is set at. The bond rate, the 10-year treasury is at above 4.5 right now, which is that 4.5 mark is a very important mark within the 10-year treasury bond. The reason for that is when we go above 4.5, we have the potential to go up in interest rates. If we go below 4.5, we have the potential to go down in interest rates. It's kind of what we call our Fibonacci level, or the level where we go up or down based on where that bond is. Right now, as of yesterday, it was sitting at 4.59. This morning, I believe it's at 4.61. So we're going to see a little bit of an increase in interest rates here, at least temporarily, until the Fed meets again in June. And then hopefully we'll get some more data from the tariffs and more data from the unemployment and things like that, and the statistics and the GDP and all those numbers that are going to be coming in that will hopefully influence the Fed to make a different decision than what they've already put on record. There are two voting Fed members right now that are on the fence and saying, maybe it is time for us to start lowering those interest rates. So 2 out of the 12 ain't bad. So we're going to get there eventually. So that's kind of what's going on with mortgage interest rates. If your clients ask, the answer is high 6s, low 7s for now. And it's probably going to stay that way with some volatility coming into the next couple weeks. So that's what's going on with interest rates. I mean, it's no different than what we had last year. We're at the exact same spot that we were 12 months ago, ironically. So with that being said, let's move on to kind of just some topics I want to talk about. Oh, student loans. This is huge right now for a number of reasons. Fannie and Freddie, if you do a traditional conventional loan, Fannie and Freddie have policies that work with income-based repayments, save repayments, standard repayments, and all the repayment options right now that are available with federal student loans. They work with those options so that if people are realistically paying on their student loans, we use those payments for qualifying. They also have opportunities that if you are on an income-based repayment plan and your payment is zero, Freddie will allow you to use that payment, Fannie will not. FHA is completely different. FHA says we will use actual payment on the credit report as long as it meets the 0.5% mark, so 0.5% of the balance, or if the payment is zero, we need to use 0.5% for qualifying. So FHA is a little bit more restrictive. Those are the rules right now. So what has changed? Well, back in January and into February, anyone that was on the forbearance plan that was done through the Biden administration, their plan came out of forbearance, which means that they were responsible for setting up a new payment plan, income-based, save plan, standard repayment, extended repayment, et cetera, by February 1st. If they did not do that and their student loan was still in forbearance, it then went into what's called a default status. What a default status means is that any payments that they didn't make while in forbearance showed up as lates on their credit, started reporting late to the credit bureaus. So therefore, you have people that were on forbearance for 18 months that did not do something with their student loans and show a ton of late payments, i.e. dropping their credit score. And there were a ton of people that were in the middle of mortgage loans, in the middle of purchasing homes that therefore could not purchase them because of the situation that happened. So that took an effect on a lot of people's credit, a lot of people's ability to enter into a payment agreement because of that default status. So the Department of Education, working with the federal student loan servicers, is now working through those forbearance people who did not make a decision on how to repay their student loans, trying to do some corrective action, some disputes to the credit bureau agencies, and try to get things corrected to show an accurate forbearance status and maybe 130-day late when they finally do get back to a new payment plan. So there has been some results of that incident that happened as far as helping borrowers to get back a more favorable status from a student loan standpoint. With that being said, everybody hears in the media the big, beautiful bill. Well, what's not being talked about in that big, beautiful bill is the changes to student loans. These are super important changes. Now, mind you, this bill has not passed. So just so you know, these are things that are in the bill that could happen but have not passed yet. So first and foremost, from a student loan standpoint, you will no longer have a save plan. You will no longer have a like a graduated extended repayment plan. There will be only two options for student loan plans. And this is for existing student loans and for any new student loans that are taken out after January 1st, 2025. The first one is called the standard plan. The standard plan uses your discretionary income and requires you to pay 1 to 10% of your discretionary income as your monthly payment. So for example, for someone who's making $60,000 a year, $50,000 to $60,000 a year, 5% of their discretionary income is going to go towards their student loan payments. For someone making $100,000 a year, 10% of their discretionary income is going to go towards their student loan payments. So basically, the US government is saying, we want our money back. Now, if you make, under the standard plan, if you make payments, standard payments for 20 years on that plan, any remaining balance is then forgiven. The other plan would be what's called an income-driven repayment plan. The income-driven repayment plan is really focused on people who earn lower incomes and helping relieve their payments. So it includes things like you don't have to pay as much if you have a child. So for every child that you have, you get a $50 deduction on your payment. It focuses on people who are making less than $50,000 a year and talks about how much they have to pay. This, if you make payments on the income-driven repayment plan, you have to make payments for 30 years before any remaining debt is forgiven. Coupled with this, is going to be any new student loans taken out for a borrower after January 1st, 2026, you are going to be limited to $50,000 a year from the federal government in availability of student loans, and a Parent Plus loan of $50,000 as well per year. You have to exhaust your $50,000 as a borrower before your parents can pay the additional 50 or sign in a loan for the additional 50. So this is very important because there was no limit before, and now they're limiting, saying, hey, you can't go into a huge amount of student loan debt because we know that realistically you're not going to be able to repay it. It also includes a provision that if a student uses $50,000 a year, so $200,000 for the entire education, and they go into a job where basically the pay on the job doesn't equate to being able to pay the student loans off, that the college is going to be responsible for paying back a portion of those student loans. So it's designed in holding the college accountable and saying, hey, we have to take some responsibility in lending to this person who may get a degree in, let's call it English, and have the potential, and an English degree has the potential to make them $30,000 a year. We need to be, have some sort of say and be responsible in how much we're willing to lend them for this education. Okay. So what it's going to do is it's going to change a lot of not only how students go to college, but on the mortgage side, it's going to change a lot on how we determine what payments to use for qualifying an individual. Because if you think about discretionary income percentages, what does that even mean? Like, what do they consider discretionary income? What do they take? Do they look at your credit report and deduct your rent amount and then take the remainder and, work out the percentage? Who knows at this point? But it's going to change the landscape for people who want to purchase homes, who are currently in student loan repayment, or who are going to be taking out student loans in the future. So a lot of changes are going to be happening. Most likely, Fannie and Freddie are going to follow the changes that are being made under the bill if it does get passed, and the idea that it's whatever your payment is based on what the federal, student loan department says, that's what they'll use for qualifying, because there will no longer be zero payments on student loans. Now, there is an option. You can still go into forbearance, but you can only be in forbearance for 9 out of 24 months. So 9 months on a 24-month period. So there are options to go into forbearance, but those are based on extenuating circumstances, medical issues, unemployment, things of that nature that would prevent you from making student loan payments. So there is an effort to say, okay, if you do have a life event that happens, we're not going to completely destroy your credit. You do have an option to go into forbearance. But mind you, it's only 9 months every 24 months. So a lot of this stuff that's happening that's in this bill is complicated, and we're going to have to do a wait and see approach from a mortgage standpoint, but there will no longer be zero payments required on student loans no matter what if this bill does pass. And therefore, I'd assume that Fannie and Freddie and FHA are going to follow suit and say, okay, whatever's showing on the credit report is what we're using for qualified, because that's what they're responsible to pay. So a lot of stuff happening with student loans. Questions?
Yeah, so what is the pulse in the mortgage world on this? Is this in your opinion, good, like thumbs up, neutral, thumbs down, if you had to give a gut feel?
If I have to give a gut feeling, and I have to say my personal opinion, is I'm giving it a mild thumbs up. The reason for that is because when we qualify borrowers right now, if we have to use 1% of the loan amount or 0.5% of the loan amount, those are large payments that we have to qualify the borrower with, even though they aren't required to make those payments. So that's, one of the positive sides is that we'll know what they're actually paying each month. Obviously, the downside is right now, if we have clients who are in income-driven repayment and they aren't responsible for making payments because their income is lower, then we have an easier time getting them qualified to purchase a home. Now, should somebody be purchasing a home if they're not paying on their student loan debt? That's not up for me to decide. So it really just depends on talking to the client, budgeting, strategy, making sure they're aware, things of that nature. Hey, if you have to start paying on your student loans, are you still going to be able to afford this house? Those types of questions that you want to ask your client as you're kind of going through the strategy. Any other questions?
No.
It's a lot. And I only gave a quick summary on that changes with the big beautiful bill as far as student loans go. So that's just a summary. There's a lot more that goes into it as far as what they use to determine this information, but it's, you know, in summary, it's going to make it quite a different landscape from a mortgage standpoint as far as qualifying goes. So my job just got more fun.
Always on your toes.
Yeah, exactly. Exactly.
Good. Wow.
I'm sure. And when did you say you said the bill hasn't passed yet?
So the big beautiful bill just passed through the budget committee for the Congress. It goes to vote in Congress, I believe, this week into next week. They believe that they have enough support to pass it first time around, but there are some Republican voters that are going on record already saying that they do not support the bill. And so it may or may not, it's going to take a little bit for it to pass through the House, and I'm sure there'll be some changes. And then if it goes again to the Senate, then we have to wait for the Senate to pass it. So the Republicans have the majority in the House and the Senate. This bill was designed by only House Republicans in a budget committee. So no Democrats were on the committee to help design this bill. So you can imagine from a political standpoint, as it goes to Congress, it's going to be probably an automatic no from a lot of Democrats without even reading it because they didn't have input.
But you said there's a couple Republicans that are already saying they're not.
Yeah, that are already on record. They're more middle of the line Republicans that have, are more on the independent side, but go under the Republican, party. So there are some goods and bads to the bill. There are some very helpful things. I think there's some helpful things for student loans and the idea that you're not going to let somebody go into $300,000, $400,000 in debt to go to college to get a job that's $40,000 a year. Things like that. And it's holding the college accountable for the majors that they're offering and the education that they're offering and the job placement that they can help with.
No.
Yeah, I think there's some good things to come of it in the future.
There are.
They wanted it passed by Memorial Day, but that again is up to
Yeah,
you.
that's I mean, it is sitting with the House right now, but I don't know when their first vote is. I highly doubt it'll pass the first time, but what do I know?
Yep. You just don't
Okay,
these
well,
days.
this is really good info because
Very good.
I was kind of in the dark on this. So
Yeah. And I would just encourage, if you do have people who are first-time home buyers or people that have student loan debt, make sure they're in communication with their servicer out of any changes that are happening so that they can make those decisions on making sure that they have some sort of payment plan set up so that they are protected in case these changes do come through and, they're made aware, but there's millions of student loan holders that don't have updated addresses, updated contact information, updated emails. So they were not getting the notifications for the February 1st changes.
Yeah.
I think something may have happened with my daughter with that. Because I remember.
I believe it. Especially for young, 20-something-year-olds who have moved around. I mean, the last thing that they think about is updating their information with their student loans,
Student loan, but all of a sudden her payment skyrocketed. She was on like a income driven payment plan, and all of a sudden it just exploded.
Yeah, because she got put on what's called the SAVE plan. So anyone who is on an income driven repayment plan as of January 31st got automatically flipped over to what's called a SAVE plan. And the SAVE plan basically is based on last recorded income and a certain percentage of the balance. So that's probably why it got increased so quickly.
Wow. Okay.
So she could go back to the servicer and work out another payment plan.
Okay.
So
I'm sure they overwhelmed with phone calls and all of this.
Yeah. I'm sure they are. I do have a client right now who is, unfortunately, their student loans got sold to another servicer in the middle of all this. So you have the one servicer that's reporting them continuously late, even though they don't hold the debt. And then you have the new servicer that can't get them set up in the system to make payments. So I have one client that's struggling with that right now. That's been going on for 3-4 months. So kind of crazy.
Oh,
Yeah.
that's fun.
Yeah, super fun.
Thank you for all that information.
Yeah.
That's good.
Yeah. So our last meeting, we kind of in-house here talked a little bit about, I think Angie brought up what was going on with insurance and HOAs and whatnot. And so maybe we can talk about that. I mean,
Yeah, I quite didn't understand the situation before, so if you could like break it more down for me, because I'm not computing.
So the questions going through the HOA and what's happening with insurance. I know with like the one that we just went through with the master insurance and everything that's changed that no one really knows about. And now, especially the HOA doesn't know. So in our case, the one that I worked through that ended up canceling, it's the HOA. And then it's the management company. And then behind the management company is the master insurance policy holding company. So there's actually three entities, and most associations, board members are members in the community that are volunteering. So it's not like a position that you have to be hired for, know our past tests or whatever. So it's a lot of, in what I saw, and this is why we want you to talk to us a little bit, the left hand definitely doesn't know what the, excuse me, right hand's doing. Walking, running, crawling. I mean, no one understands what they don't understand. And I know, Nikki, I love the comment you made at one point. You said, you could literally make a career right now going out and being a consultant for these HOAs because no one understands what's going on. Therefore, we're not educated on it, and it just all happened this first quarter, and there was no like like turnabouts. All of a sudden, turnabout showed up everywhere. You just drove up and you had to figure out how to do a turnabout. So it's kind of like this, a roundabout type of a thing.
Yeah.
So same thing here. So we'd love to have a little bit of education on where we're at as it sits today.
Okay, so big changes implemented from HOAs and the insurance requirements, as you mentioned, Angie. I will preface this by saying us in the lending world, we've been known about this for 6 months before it changed in January. And it is impossible for us to get the word out in a meaningful way to every single HOA and every single association management company. Here's what I will say. Most HOAs do have an association management company. That association management company is responsible for helping the board members with budgeting, insurance, reserves, maintenance items, assessments, things of that nature that help the association run. It is also their responsibility to fill out lender questionnaires as it pertains to individual homeowners purchasing homes or refinancing homes within the community. These lender questionnaires ask questions about ownership, in other words, percentage of ownership by primary residence holders, second home residence holders, and investment home residence owners. What percentages are owned by those types of qualifying borrowers? It asks questions about how many in the maximum number of properties that one individual owns or one entity owns within a community. It asks what the reserve amount is. It asks about different budget questions, and it asks about HOA coverage and special assessments. These are all important things that changed from a requirement standpoint as of January 1st to make sure that associations have healthy budgets, proper insurance coverage, any deferred maintenance taken care of, and to make sure that if there was a special assessment, that the homeowners have the ability to pay for it outside of anything that's already in the reserve account for the HOA. First and foremost, insurance. It used to be that if you had at least $1 million in liability coverage and $2 million in building coverage, that you could qualify and pass on the lender questionnaire or the lender requirements. The important change that happened was the deductible amount. It used to be that you could have a higher deductible for your master policy insurance because that deductible amount is paid for by the members of the association, the homeowners. So for example, if you had a $25,000 deductible and there was, 250 homes, everybody has to pay $1,000. That homeowner in their personal insurance policy has coverage to cover their portion of the master insurance policy's deductible. Does that make sense? So $25,000 deductible, each home is assessed $1,000. That homeowner says to their insurance company, hey, I'm assessed $1,000 for deductible on the master insurance. The homeowner's insurance policy says, no problem, we got you. Here's your $1,000, goes to the master insurance, you're covered. Okay. What was happening is that you'd have $100,000 deductibles, $25,000 assessed per owner, insurance coverage on the per owner's end of $5,000. So all of a sudden they have to come up with $20,000. So that's the reason that deductible amount or percentage changed. It is now no more than 5% of the coverage amount. So in other words, you cannot have a deductible that's $100,000 for the homeowners. It's going to be more like the $25,000 as described. It can be no more than 5% of the replacement cost coverage for the building, for the master insurance policy. On the flip side, the HO6 policy or the homeowner's personal policy is required to have coverage for the deductible for the master insurance. They don't really say how much, but they are required to have that coverage so that that policy will kick in, pay for the master insurance deductible to fix whatever needs to be fixed. So this is a huge change. Most insurance policies are at somewhere around 10%. Most master insurance policies are somewhere around 10%.
I got a question.
Yeah, go ahead.
So I just wanted to know on the HO6, then, is that something that they can put into the HO6 that it would pay the deductible up to a certain percentage?
Correct. Yeah, it's either a certain percent. Most of the time it's a dollar amount. Most of the time we see up to $5,000, but they can elect to have more.
Okay.
So if their insurance agent should be able to talk to them about the options, should be able to look at the master insurance policy and should be able to say, hey, FYI, this master insurance policy, you're going to be responsible for $6,000. We'll cover you for at least that much, whatever that amount is. That's what should be happening in theory.
Right.
So
I have one client who I've been trying to deal with their association, the big one that they have, and they're like, oh, you know what? Our insurance hasn't been updated here since 2018.
Mm-hmm.
So they don't have any idea what the deductible or anything is.
Correct.
Oh, wow.
So what's happening is, as these policies come to renewal, the association management company is supposed to renew the insurance in compliance with Fannie Mae and Freddie Mac guidelines when it comes to coverages. Now, whether they do remains to be the question. So a lot of times, when you are renewing master policy insurance, it comes up every year to renew. Most of the time, homeowners, board members, association management companies, they don't look at it. They're just like, renew it, move on. Well, what's happening now is the increase in cost of insurance in general is causing a lot of these HOA management companies and HOA board members to say, whoa, 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 wait a second. This is a major increase to our insurance cost. What's going on here? The other thing is, so they'll have to correct it at that point. The other thing is let's say you have a homeowner that wants to purchase a home and close end of May. That new insurance policy doesn't kick in until August, let's say. So in other words, they know they need a correction. The new insurance policy will have the correct deductibles that fall within compliance of Fannie Mae and Freddie Mac, but that won't go into effect until August because that's when their renewal is. Fannie Mae and Freddie Mac say, if that renewal is within 60 days of your closing date, and it is in effect by the time that the client makes their first payment, then it is acceptable. If you are closing May 31st, your payment is July 1st. If that new thing doesn't go into effect until August, nope, got to delay closing. Does that make sense? So, yeah. So what else? I've seen board members say, okay, can we look at renewing early? Well, if they look at renewing early, it's costing them double insurance basically for however many months that they're renewing early at. So in other words, if the policy goes from August to August and they need it renewed in June, they've already paid the August to August, so they're basically double paying for June and July. So a lot of associations are saying, no, we're not going to do that. That's not a fiscally responsible thing for us to do.
So in the case, Nikki, of what, I went through with this, and back when this happened, I had a seller who, we had the buyer, it was 2, 3 weeks past closing, they had moved out, and ended up canceling because of this reason. What can we do as agents to get to this very quickly? Because it took 2 to 3 weeks for us to get to the right person within, again, the association, the management, then the insurance master policy. And then the association said they could approve it, but then the master insurance policy person's like, not a chance. But yeah, we can. And there's just, so again, no one knew what they didn't know. So we can protect our clients. Who do we go to? What questions do we ask? And how do we get to this quicker than 3 weeks when you have your seller sleeping on a blow up mattress, 2 pots and pans moved out?
Yeah. Okay. So question. In Minnesota, and I'm somewhat familiar with this, but I know that when you sign a purchase agreement, you have up to 10 days to get the condo docs, correct? Condo or townhome docs. Okay. Then how long is your review time? Does it still
10 days.
It is still within those 10 days. So they have to give them to you and you have renew time. Do they have to give them to you within a certain number of days? Or is it just everything has to happen within 10 days?
Once they give them to you.
Day one
within 10 days.
starts.
Day one starts once they are handed over. Okay, cool. That's what I thought. In
Including
Arizona, it's a little different. They have up to 30 days to review them. Okay. So in that 10-day mark, I would actually suggest that you as a listing agent put those documents up on the MLS, upload them to the MLS. You as a listing agent, get a hold of that master insurance policies, talk to a lender, say, hey, I have this master insurance policy. I need you to review this and this lender questionnaire. I need you to review this for listing purposes. No problem. I'll review it. Not a problem. No big deal. Don't ever, 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 ever trust what another listing agent is putting online as far as approved financing for any condo or any townhome. Love you, agents. You guys can do all the research in the world, but 90% of the time that information is inaccurate. So that's just how it is. Even though they think they know, oh, how'd you buy this house? Oh, I bought it conventional. Doesn't mean it's approved. It doesn't mean anything because things could change. And therefore it's on you as the listing agent. Number one, do your research and make sure it can do it. But not all the agents are doing it and they don't know who to talk to and they don't know who to contact to get those documents into the right hands to get reviewed for FHA and conventional financing. Okay.
Mhm.
As a buyer's agent, if those documents are not on the listing, talk to the listing agent, see if you can get the documents before they even make the offer. And then again, have me take a look at them and say yes or no, because it'll take me 20 minutes to review something and say, hey, the insurance isn't going to be good. You're going to be screwed up here, or the reserves aren't enough, or there's too many investment property owners, or there's too many owned by one person. Whatever those problems are that continuously come up with associations, those are going to really help your client determine what they're going to offer and how they're going to offer on any property.
So with the client that I'm working with right now, he had gotten a notice before our first listing consultation that his insurance company was canceling him, but switching him over to another company that offered an HO6.
Mhm.
So I think that means that.
So that's personal insurance. So there's two types of insurance. There's the
Okay.
master insurance
Well, I know that. Yeah.
association, and then there's his personal insurance. Maybe his personal insurance company just said, we're not doing HO6s anymore, but this other company is. That's probably what happened. A lot of insurance companies like State Farm and things like that are pulling out of HO6 policies because of the liability it holds with the master insurance, and they're seeing that the master insurance policies aren't exactly where they need to be. So they're saying we're not going to cover this mess that's inevitably going to happen over here. Now, with that being said, a little trick. If there are reserves that are a little bit short of Fannie Mae and Freddie Mac's requirements, you can obtain 6 months of meeting minutes from the board to determine whether there's assessments, indication of deferred maintenance, assessments that are going to be coming up that are not assessed yet or that could cause problems in the future. If in those 6 months of meeting minutes, they don't mention anything, it's just business as usual, then you don't have as much of a reserve requirement restriction. So we use that a lot because a lot of these places do not have reserve requirements met. So there are options in that realm to say, okay, they don't quite meet the reserve requirement, but we know that over the last 6 months, there's been no mention of a deferred maintenance item such as roofing, decking, asphalt, parking lots, painting, landscaping, pool maintenance, et cetera, et cetera, et cetera, go down the line. And there's been no mention of special assessments from a tax standpoint or from assessing the homeowners for any of these expenses. Therefore, we know that nothing's going to come up within the next 3 to 4 months. And we can likely say that. So there's a lot that happens with HOAs. Like I said, as a listing agent, send me the insurance. Send me the insurance. If the only thing you do is send the insurance over to me and say, hey, can you take a look at this? That's one way to prevent a lot of problems. If there's reserve requirement issues, investor issues, things of that nature, those things can be either resolved or we can use what's called a non-QM product or a non-warrantable condo product to finance it. But if the insurance is screwed, you don't finance it, plain and simple.
That's what I'm not understanding, because you said Freddie and Fannie set the guidelines. So
They
that
do.
means it's just conventional, or it's conventional, FHA, DVA, all of them?
The insurance requirements for any lending are the same. FHA, VA,
So
Fannie,
that's why
Freddie.
harder for buyers, they would have to do a loan that's a little bit different.
If the insurance is screwed up, they're not getting a loan.
Correct.
Any loan.
Any loan. Well, they could go to a local bank and a local bank could be like, yeah, we'll take a chance on the roof not falling off in the next 12 years. No problem. But I highly doubt it. So if the insurance is screwed up, they're not getting a loan.
So it's just something these associations are going to have to work through to get proper insurance,
Correct.
to be able to sell their home right now.
Correct.
That's just a time issue then.
It is a
Okay.
time issue. When does the insurance renewal come up? Is the board willing to renew earlier? Make changes earlier than the renewal time? And will the insurance company insure them for the proper amount?
Yeah.
Or do they have to change insurance companies?
Okay, thank you so much.
Yes. So just as a reminder, this all happened, all of these changes happened because as a result of the condo collapse in Miami. Okay. Florida has extremely restrictive policies within their HOAs right now that basically say that by January 1st, 2025, the reserve requirements for every association in the state of Florida had to be fulfilled. They had to have enough reserves and all of their insurance had to be changed over by January 1st, 2025. That was a Florida specific law that happened. So when Florida, sorry, my cat loves to bug me while I'm on Zoom. So in Florida, if you are in an HOA in Florida, you're going to have proper insurance and proper reserves by now. The problem that happened in Florida is if you had an association that didn't meet the reserve requirements, of course, that gap was assessed to the homeowners, and we saw HOA dues go from 300 to 3,000 to make up for the reserve requirement within that time frame. So that's been a huge issue in Florida now. A lot of people trying to sell their condos with HOA dues of 1,000, 1,500, 2,000, which is more than the actual payment. Therefore, the values of the homes are decreasing because people just can't afford to buy them at the purchase price with those HOA dues. Now, in theory, could they have made the reserve requirement and lowered the HOA dues back down? Yes. But will they? Probably not. So it's a huge problem in Florida, or it was a huge problem in Florida. It's a huge problem now with the HOA dues, but in like Minnesota and Arizona, most of the time the reserves are okay. It's the insurance that they have to be working through this year, most of the year, this year. And if the board members don't know, it's up to the association management company. If the association management company doesn't know, or they don't care, or they're just collecting their fees and they don't really pay attention, it could go unnoticed for the entire year, which I've seen happen as well.
Oh, my seller, 2 days before.
No, can you guys hear me?
Yep, we can.
Now we can.
I'll tell you.
You're back. Okay. You were frozen for a little bit. But yeah, I mean, that's like the HOAs are going to continue to be an issue for everyone this year. And like I said, if you're a listing agent, get those documents on the MLS for review. If you are a buyer's agent, get a hold of the master insurance at the very least and send it to your lender. And if you're a listing agent, get a hold of the documents and send it to your lender anyway.
Yeah.
So the other thing that we can do, and this applies to not only just condos and townhomes with HOAs, but this applies to any single family residence. The new kind of idea behind listing homes right now and kind of, instead of talking to your client about a price drop, things of that nature, what we can do is we can say, okay, for this specific listing, we will offer, the seller is willing to offer a 5.99% interest rate buy down to any buyer that comes in. The reason that this is important in the condos is basically what happens is if you say, let's just say you have a home that's you listed for $500,000 and it's just not getting a lot of activity. Your first gut instinct is going to be what? Lower the price, right? Well, instead of lowering the price, it might be more attractive to say, okay, we're going to attach a mortgage loan offering to this property that's going to offer a 5.99% interest rate if you purchase this property, and the seller is going to pay that buy down. So on a $500,000 property, let's say the buy down's 3%. So the seller is paying 3%, $15,000 to get a buyer in there basically to get a loan at 5.99%. Why that's advantageous is number one, you're not having to lower the purchase price, but number two, it actually helps get more buyers qualified at lower interest rates. So what you're doing is basically saying, we'll sell your home for more. And if we do a price drop, you're going to lose out that money anyway. So we might as well take that money and use it to your advantage. So in other words, instead of saying, let's go from 500 to 485, that 15,000 is gone and has literally no use to it. But at 500,000 with a seller buy down to, let's call it 5.99, 5.875, whatever that amount is, all of a sudden that 15,000 that they were going to lose anyway is now put to good use in attracting more buyers. This can be extremely helpful in condo situations because then you have a lender that's already reviewed the condo, already has approval for it, and can basically plug and play any buyer in there. So it helps with condos, getting the HOAs reviewed, getting those approved in advance so that buyers coming in can actually close on loans. And number two, helping on any listing, single family listing, if you're looking at a price drop. Use it to your advantage. Take that price drop money and use it to offer to buy down a rate to the buyer. Builders do it all the time. Builders offer 4.99%, 5.5%, whatever they offer, and they just work that amount into the sales price. The buyer's just paying more for the house. It's the same way with this. Buyer's just paying more for the house. So it's a good strategy. I've started using it, especially in Arizona. That's all we have is condos down here, basically. HOAs. I shouldn't say all we have, but there's a ton of HOAs down here. And it's been pretty effective in saying, okay, the HOA's already been reviewed. Let's get a buyer in here and plug and play.
Love it. Yep. That's good. That is good.
Okay. Good info.
Very good.
Yes. What other general questions do you guys have? I know it's a lot of information.
Do we want to, can you hear me, Nikki?
Mm-hmm.
Do you want to just kind of touch a little bit, let these guys know? I just kind of mentioned we've got a mutual client that we have them ready to go with the knock program to help.
Yeah, I can talk about it a little bit.
Purchase. With
Yeah. So knock lending is basically a cash buyer for the client's home. When a client is going in and they have to offer contingent upon the sale of their house, obviously that can be a detriment to competing with other offers on homes that can go non-contingent. But basically knock lending does is it writes a purchase agreement for that client's home and advances their down payment on the new home via earnest money. So in other words, if your home that you have to sell is $500,000 and you need $100,000 to put as down payment on the new home, knock will write a purchase agreement for $500,000. and give you earnest money of $100,000 so that you can close on that home. The reason that this works is that Fannie Mae and Freddie Mac say that as long as you have an accepted purchase agreement with no financing contingencies, closing any time after your next purchase, with a close date any time after your next purchase date, as long as there's no financing contingencies, you are considered a non-contingent buyer. Knock Lending writes a purchase agreement for cash, gives you $100,000 or whatever it is that you need for your down payment on your next house, and then writes a close date 6 months after your purchase date on your next home. So the listing agent has up to 6 months to sell it to anybody. And if they don't, Knock Lending will come in and purchase that house at the agreed upon sales price. Why this is interesting is it does come with fees around 2.25% of the purchase of the list price. But if you are in a situation where you need to offer non-contingent, you do not have to pay that 2.25% upfront to knock. You can have it in place so that in case your home doesn't sell, by the time you close on the other one, you know that there is a purchase agreement there. Now, not only do they collect the 2.25% as their fee, but they also collect that 6 months of mortgage payments right away as well. So in other words, that mortgage is paid. You are truly a non-contingent borrower. With your home already sold at the agreed upon price, you already have your down payment on your new house, you already have accounted for the 6 months of PITIA on your home, and you can use that money and put yourself in there as a non-contingent buyer. Super useful tool, especially for people who have a lot of equity in their home. They don't go to 100% of the purchase price, but they'll go to like 90% as far as how much money they'll give you up front. So like from an earnest money standpoint. So it's super useful. We're using it with one of Chrissy's clients right now. They happen to have gotten a purchase agreement within the meantime that they accepted. So we won't need the knock lending, but it is something that as long as you can be approved for a normal mortgage loan, you will get the approval for the knock lending. And it's 0%, $0 payments, etc.
So
Yep.
Chrissy, do you write that offer as a cash binder?
No,
Okay.
no,
Okay.
but it's a non-contingent
How can you
with just a normal down payment.
put that non-contingent?
It's for
Because it
backup.
is, so it is non-contingent because we have the knock program approval. And so either way, the house is gonna be, we're gonna have the down payment and they can purchase non-contingent.
Okay.
Whether we get their house sold beforehand or
Mhm.
not, knock is stepping in.
So you don't.
and
you
It's like an ace in the
take none of
pocket.
That section, because it's just done.
None of the financing is like, is that what you're saying?
Yeah, I don't.
You don't put on
understand
anything on the
financing.
finance.
Yeah, like,
And that part where it says buyer, yeah, I guess you wouldn't. Be like a cash buyer then?
No, because it's not a full cash. It's still being financed.
Well, no, they'll pay knock pays cash for it in 6 months if it doesn't close.
Yes,
Yeah.
correct.
Mm-hmm.
Write the offer as we didn't write the offer as a cash offer because they'd only be coming in with $100,000 down.
Yeah, you didn't write their offer as a cash offer, but the offer that knock sends is a cash
I
offer.
get that. Just, yeah, what you were saying
Yeah,
about the purchaser.
the purchaser of their home is a cash offer from knock.
Yeah, but the person that got the cash offer from knock, now they're purchasing. How does that go in our purchase agreement?
Yeah, I'm wondering how the listing agent would know this is special by looking at your purchase agreement.
It's not any different than any other offer. There's nothing,
But it is because it's not contingent on financing. And so that's attractive, isn't it, to the listing
Nikki,
agent?
can you hear?
Not really. Something about,
You should have just sat down.
I said, well, as a listing agent, how would we know this is a more special offer? How would we know this is not contingent? And so I'm asking how she filled out her PA to let them know that, hey, this is a sure deal.
so, okay, so let me explain it from the beginning. So you have the home that you're selling. Knock comes in and says, I'm gonna write a purchase agreement offering cash purchase for this home 6 months from now.
What?
So you have a purchase agreement from Knock that's going to close 6 months from today. they're gonna buy it cash.
Oh,
So your
they're
home
buying
is
your home,
sold.
so you don't need to sell your home.
Correct.
But
Correct. You can sell the home anytime within that 6 months and not have to use knock. So you're not even committed to them.
So the goal was, let's hurry up and get your house listed. And we are really gonna ultimately try to get your house sold, period,
Mhm.
before
The
the
6
closing date
months.
of your purchase.
Mm-hmm.
If we can't, we have knock as a backup. We already have
Okay, I
that lined
think I'm
up.
starting to
But
follow.
we're trying to save them the fees
Okay.
that are associated with going that route. Either way, the house my clients are buying, they have to close on the closing date because it is a non-contingent offer. So if for some reason we can't close on the sale of their house with this other buyer,
Okay,
we're gonna have to divert
Invoke
to,
knock, yep.
we're gonna have to
Okay.
assume those extra fees.
okay.
Yeah,
So you're just
Sorry,
writing
it takes
purchase
me a minute.
Oh,
agreement,
you're good.
contingent, this amount down.
correct, just like
this
any other
amount
offer.
more, and then there'll
Yeah.
be, but you're not putting any kind of a mortgage amount on the new house.
Yes, you are. You're just using you are, because you're just using the equity of your home in advance is basically what happens. So that earnest money amount that knock puts on the purchase agreement is the amount that they will send you to put as down payment on the new house. It could be all cash, you just don't know. I mean, it could happen to be that you don't need a mortgage on the new purchase, but most of the time you will because you only have a certain amount of equity. So for example, you owe $300,000 on your house. You're listing it at 500,000. Knock comes in and says, we're going to pay 500,000, but we're going to give you $100,000 as earnest money. You take that $100,000, you're non-contingent as down payment on the new house.
Yes, on the new house.
And then you mortgage the rest of it.
You're trying to make an offer to get a new house for your clients.
Mhm.
And
But, I think your question, can you hear me, Nikki?
Yep.
I think the question is there a finance contingency on the offer?
Yeah.
And
On the offer of the home that you're purchasing?
I still included a finance.
Yeah, of course, because they don't, in this case,
gotcha.
you're only getting $150,000 in equity. So you're not going to buy a house for $150,000. That's going to be your down payment amount. So you have to finance the rest of what you're purchasing.
Yeah.
it's just non-contingent
The
on the
bonus
sale
It's
of the.
non-contingent on the sale,
But you-
not non-financed.
So
Yep.
I'm like,
Yeah, unless
Kirk's got it.
it's still contingent on finance.
okay.
Yeah.
It's contingent on financing, not contingent on the sale.
Yep, so
Okay.
business as usual.
Yeah.
Business as usual. Yep. Now, this only works for FYI, this only works for conventional buyers. This does not work for FHA buyers because FHA buyers do not have the same guideline from a closing financial contingency standpoint on the lending side.
All right,
So-
well, I'm throwing it out there because, but
Another
you have
tool.
to have enough equity in your house.
Yeah.
In order for this to work.
Yeah, you do.
We talked about another client and they don't have it. Do you know what the threshold is for equity?
90%. So so they'll go up to 90% of the home of the listing price. So between what they owe on the mortgage and 90% of the listing price, that's the amount that they'll give you basically. Minus the
But
fees.
The sellers have to have in their home, the homeowners, like how much equity do they have to have?
Well, I would say at least 20%. Because they're only going to need 5% on the new home. 5% to close, but I would say at least 20%.
Okay. All right.
That'd be a good threshold.
Okay.
That'd probably be the minimum I'd want.
Okay.
So,
Well-
yeah, it's a good program. I mean, very easy to use.
Mhm.
So,
Okay. Well,
what
this
other
was-
questions do you guys have?
Anybody else have anything? We're obviously over our time, but
Yes, thank you for all the great
Yeah, really
information.
good.
yeah.
Absolutely.
Can you hear me?
Yep.
Does the student loan situation affect credit score at all?
The knock loan? No,
No,
no, knock does not
Oh,
affect credit. Yep.
Does-
Doesn't affect credit at all.
wait, you just said student loan.
Student loan.
Oh, I thought he said, what's
Back
the,
to-
which
So he's
part?
saying- What do you mean? Yes. student
Well, the
loan.
whole thing with the student loans, does that affect, debt to income and all that?
Yes.
When that
Yeah.
starts? Okay.
Yeah, so a lot of people have already been affected by the change that happened on February 1st. anyone that didn't declare what they wanted to do with their student loans. They were affected. If this new bill passes, there'll be some time that you can switch. Oh, and also the other provision in it is if this bill passes, you will automatically be put on the standard payment plan unless you say otherwise. So you won't have the same situation that happened where all of a sudden there's late payments reporting and you didn't go make your decision and all these things. You will automatically be transferred over to the standard payment plan if if you're on one of the ones that isn't available anymore.
That could be a lot.
Yeah. Well, I mean, I'm just wondering, for me, it's like, I'm just wondering going, gosh, how are they going to determine discretionary income? That's insane. Like what goes into that and what doesn't? What does that even mean?
You said
crazy.
you determined there's
I know,
lot
TPD, right?
well,
Think
we're
of my daughter with 3 kids. I don't think there is any discretionary income.
Well, that's exactly the point, And then is it discretionary income of the borrower or is it discretionary income of the married couple? Or is it discretionary income? You know what I mean? Like, what does that mean? And then also, I mean, the VA, for example, has residual income requirements that you have to meet in order to qualify for a mortgage loan. So I wonder if it's going to follow their same guidelines as far as discretionary income. Who knows?
Interesting.
Yeah, but if you think about let's say you have what they determine to be $500 a month in discretionary income, and you're saying, oh, that's 10% of that, that's a $50 a month payment. So you make a $50 a month payment for what, 20 years, and then the rest of it is forgiven. I mean, 20 years is a long time, but people have been sitting with this student loan debt for 30, 40 years.
I just paid off my student loans last month. 30
I still owe $29,000.
30 years.
So 20 years.
I know. I'm 30 years later and I still owe $29,000. And guess how much I started with?
how much?
31.
Yeah.
Ouch.
Right.
That's how if you guys really if you really looked into the student loans and how they operate and how predatory they are, it is crazy how much you can end up owing on those student loans if you go on different payment plans and stuff like that, because they're basically, a lot of them are negative amortization. And I can't, it's just crazy that they let it go on this long.
A racket.
Racket.
It is. And it's been a mess for a really, really, really long time. And this solution isn't going to be a great solution, but it's a solution.
It's headed the right direction.
It's headed, hopefully. Yeah. I mean, at least there's some forgiveness in there, and at least it's based on discretionary income and not, hey, we're just going to start screwing you over and have you pay 1% of the balance. I mean, the amount of, and then holding the colleges responsible as well is probably a good thing as well. So, all right, you guys.
Right. Then
You
what
did
does
really
that
great.
look like?
Thank
Like
you.
dominoes? Yeah.
Yeah, I know.
All right.
We'll
So,
have so much to talk about too. So anyone listening to the recording or in this room, Nikki and I meet every Monday, 11:30 Central Standard Time for a quick 20-minute. And this is the type of stuff Nikki brings. I don't talk hardly at all. I'm like, Nikki, what's happening? What's new in the market? And we'll go up to 20 minutes of just this type of stuff that's so important. So if you can't make it to that Zoom live, then definitely watch the recording. I put it on LinkedIn, I put it on YouTube, I put it on Facebook. And Nikki is on all the channels, TikTok, Instagram, Facebook, every day. She's posting this type of information that's so very helpful. Show up and educate your clients. She has given us permission to rip off, duet, stitch, rinse and repeat anything that she puts out online, we can use as well. So, she is the person to go to with any questions. So we really appreciate you. She's been doing this for a very long time. And her stuff.
50 years.
So yeah, 50 years. I didn't say that. That was her.
you see how young I look for doing this for 50 years?
It's beautiful for 70. No, I'm kidding.
Okay.
It's kind of
Yeah,
what you
exactly.
feel like sometimes, I bet, with some of these situations we put you through.
Yeah, no, 26 years. So
Nice.
long time.
Cool.
Yes.
Well, thank you so much. We appreciate you. And
absolutely.
we'll talk soon.
All right. Bye, guys.
Bye.
Bye.
Thanks for joining us today. And be sure to check out my ebook, From Hustle to Harmony for Real Estate Agents on my Stan store, stan.store/Angie Gerber. And until next time, remember, nothing changes if nothing changes. Now go sell something.